What if I told you the biggest money move of 2025 isn't happening on screens? It's happening in silence. No headlines, no breaking news, no hype cycles. While everyone argues about Bitcoin targets and gold price predictions, something else is happening beneath the noise. Quiet, methodical, almost invisible by design. Here's the uncomfortable truth. By the time financial media talks about an asset, it's already too late. That's when exits begin, not entries. And right now, the ultra-wealthy aren't chasing returns. They're preparing for failure, systemic failure, currency stress, supply shocks, political chaos. This isn't a crash prediction, it's pattern recognition. Every major wealth transfer in history followed the same script: public optimism on the surface, private repositioning underneath. Rome, Britain, the gold standard, Bretton Woods. Different eras, same behavior. When systems feel permanent, elites move first. Not loudly, not emotionally, but legally, structurally, and quietly. And here's where it gets interesting. They're not buying what you think. Not stocks, not tech, not crypto headlines. They're accumulating assets most people would call boring, irrelevant, even old-fashioned, which is exactly why they're dangerous. Because boring assets don't collapse overnight. They don't trend on social media, and they don't need belief to function. They work even when trust disappears. This video isn't about copying billionaires. You can't. Different rules, different access, different leverage. This is about understanding why capital is moving where it's moving, and what that says about what's coming next. 3 assets: obscure, overlooked, almost never discussed on YouTube, yet accumulated relentlessly through shell companies, private funds, and entities you'll never see on CNBC. These assets share one thing in common: they don't depend on markets functioning normally. They survive inflation. They survive political chaos. They survive financial resets, food, water, and disaster itself. That combination should already make you uncomfortable, because when the smartest money on earth prepares for scarcity instead of growth, it's not optimism, it's insurance. And the first asset on this list will surprise you, not because it's exotic, but because it sounds painfully ordinary. So ordinary, most people ignore it completely. That's exactly why billionaires didn't. The first asset isn't futuristic. It doesn't glow. It doesn't trade 24/7. And it definitely doesn't make influencers rich overnight. It's land, but not the kind people flip. This is where the story turns unsettling. Because when billionaires buy farmland, they're not thinking about crops. They're thinking about control. Food isn't just nutrition. Food is leverage. Always has been. Empires don't collapse when markets fall. They collapse when food systems fracture. And one man understood this earlier and more aggressively than anyone else: Bill Gates. While the world watched his public philanthropy, something quieter was happening behind the scenes. Year after year, state after state, farmland acquired systematically through investment entities most people never bothered to track. As of now, Gates is the largest private farmland owner in America. Not by accident, not by diversification, by design. But here's the part nobody focuses on. He didn't buy any farmland. He bought specific land in specific locations with specific characteristics. And when you map it out, a pattern appears. These farms sit on top of deep aquifers, next to major river systems, inside regions with long growing seasons, soil that took thousands of years to form, water sources that can't be replaced. This isn't agriculture, it's infrastructure. Because food shortages don't start globally. They start regionally, then spread. Climate volatility shrinks usable farmland. Droughts turn productive regions into liabilities. Supply chains snap under pressure. And when that happens, the land with guaranteed water doesn't just become valuable, it becomes non-negotiable. Here's the conspiracy-adjacent part no one likes to say out loud. You can print money. You can rewrite laws. You can manipulate markets. But you can't negotiate with biology. Crops need water. Soil needs stability. And people need food, whether markets are open or not. That's why these purchases weren't publicized. No victory laps, no interviews. Because once people understand what's happening, the prices explode. And Gates isn't alone. Pension funds, sovereign wealth funds, family offices older than countries. They're all circling the same type of land. Not land that looks profitable today. Land that stays productive when everything else fails. But farmland alone isn't the real prize. The real power lies beneath it. And that brings us to the second asset, the one that makes farmland truly dangerous. If farmland is the body, then this next asset is the bloodstream. Invisible, ignored, and absolutely fatal if cut off. Water. But not water the way you're thinking. Not bottles, not utilities, not rainfall. Ownership. Specifically, water rights. This is where the story stops sounding like investing and starts sounding like strategy. In large parts of the world, especially the Western United States, water doesn't belong to whoever owns the land. It belongs to whoever claimed it first. Centuries-old legal language. Modern-day consequences. You can stand on 1,000 acres of land and still have no legal right to touch the water underneath it. And when scarcity hits, laws don't bend, they snap. Water rights follow a brutal rule. First in time, first in line. If you own senior rights, you drink. If you don't, you wait. And when there's nothing left, you get nothing. This is why billionaires didn't just buy farmland. They bought farmland with water attached. That distinction changes everything. Because water rights can be separated, bought, sold, leased, quietly. And once cities grow faster than reservoirs, desperation sets in. Here's what never makes headlines. Cities don't run on money. They run on water. And when growth collides with drought, the only solution is purchase. This is where some of the most aggressive accumulation in modern history took place. Not through markets, through contracts. Ranchers selling rights they didn't realize were worth fortunes. Farmers trading long-term security for short-term liquidity. And on the other side of the table, entities with patience. Lawyers. Time horizons measured in decades. Water doesn't crash. It doesn't get disrupted. It doesn't go obsolete. Scarcity only pushes its value in one direction. This is why certain private investors now control access to rivers, aquifers, and storage systems built with public money, legally, permanently. When droughts intensify, those rights don't lose value. They gain leverage. And here's the part that should unsettle you. Food can be grown somewhere else. Factories can be rebuilt, markets can reopen, but water rights? Once consolidated, they don't come back. Which is why the smartest capital on earth moved on them before anyone was paying attention. But even water isn't the final layer of protection. Because what happens when disaster itself becomes predictable? When floods, fires, storms, and earthquakes stop being rare events and start becoming seasonal patterns, that's where the third asset enters. And it's the one almost nobody understands, even inside finance. What if you could profit from disasters without owning a single piece of land, stock, or commodity? That sounds unethical or insane. But it already exists, quietly, legally, at scale. This is the asset Wall Street never explains on television because it doesn't fit a simple narrative. They're called catastrophe bonds. And if that name makes you uncomfortable, good, it should. Because these instruments only exist for one reason. The system expects disasters now. Here's the simple version. Insurance companies insure homes, cities, entire coastlines. When storms were rare, traditional insurance worked. But when disasters became frequent, the math broke. Too many claims, too much exposure, too little margin. So insurers found a way to export risk, not to other insurers, to investors. Catastrophe bonds do one thing. They pay you high yields, as long as a specific disaster doesn't happen. No hurricane, no mega fire, no earthquake above a certain threshold. If nothing happens, you win. If it does, you lose everything invested. Binary, cold, mathematical. And that's exactly why billionaires love them. Because these bonds don't care about interest rates, elections, or recessions. They don't react to market panic. Stocks crash, cat bonds don't notice. Currencies wobble, cat bonds don't care. They're tied to physics, weather, geography. That makes them uncorrelated, which is the holy grail of risk management. In a world where everything moves together, anything that doesn't becomes priceless. Here's the uncomfortable pattern. As climate volatility increases, insurance premiums rise. When premiums rise, cat bond yields rise. Disaster risk increases. So does compensation. That means the worse the world gets, the better these bonds pay, as long as you're diversified enough to survive individual losses. This isn't gambling, it's probability stacking. Pension funds understand this. Sovereign wealth funds understand this. Family offices definitely understand this. They're not betting on one storm, they're betting on averages across decades. And over time, the math favors the house. But here's where things get darker. The cat bond market is exploding now, not gradually, violently, which raises a disturbing question. Why is so much capital rushing into instruments designed to absorb catastrophe? What do they see coming that most people don't? Because when money starts preparing for disaster instead of growth, it's not optimism, it's anticipation. And the way this market is changing in 2025 makes that impossible to ignore. Here's where the timeline matters. Catastrophe bonds didn't explode after a single disaster. They surged after something far more unsettling: correlation failure. In 2022, the unthinkable happened. Stocks fell, bonds fell, at the same time. The safety net failed. The foundation of modern portfolios, diversification, collapsed in real time. For decades, investors were told one thing: when stocks fall, bonds protect you. That lie died quietly. And when that illusion broke, serious money started searching for assets that didn't depend on the economy functioning normally. That's when cat bonds went from obscure to essential. Returns didn't just beat markets, they ignored them. While indices bled, catastrophe-linked instruments stayed stable, some even rose. Because recessions don't cause hurricanes, rate hikes don't start wildfires. This is why the market changed in 2025. Originally, most cat bonds covered a narrow risk: U.S. hurricanes, Florida, Texas, the Gulf. But now, they cover earthquakes in Japan, wildfires in Australia, floods in Europe, even mortality risk. That shift matters. It means insurers no longer believe disasters are regional anomalies. They see them as global constants. And here's the part nobody discusses publicly. Primary insurance companies are now issuing cat bonds directly. They're bypassing traditional reinsurance entirely. That's not innovation. That's necessity. When insurers change their architecture, it signals stress deep in the system. Cat bonds are no longer optional tools. They're structural supports. And whenever a financial instrument becomes structural, it stops being niche. That's when early access ends. The same thing happened with mortgage-backed securities in the late 1990s. Ignored, understood by few, then suddenly everywhere. Only this time, the risk isn't human behavior, it's nature itself. And unlike credit cycles, nature doesn't negotiate. So now we have three assets being accumulated simultaneously: farmland with water access, water rights themselves, and financial instruments that profit when disaster becomes routine. That's not diversification, that's preparation. Which leads to the most important question in this entire video. Why these three? What do they have in common that gold, stocks, and Bitcoin don't? The answer reveals the real strategy, and it's not about returns. At first glance, these assets don't belong in the same category. Land, legal rights, complex financial instruments. But strip away the labels and a single logic appears. They all function when trust disappears. Markets run on trust. Currencies run on trust. Even governments run on trust. But food doesn't. Water doesn't. And disasters definitely don't. That's the connection. These assets don't require belief. They don't need confidence. They don't collapse because sentiment changes. They operate at the level of survival. That's why this strategy feels unsettling. It's not about beating the market, it's about outlasting it. Let's break it down. Scarcity. You can't manufacture more prime farmland. You can't create new senior water rights. You can't invent new low-risk catastrophe probabilities. Everything here is capped by reality itself. Essentiality. Food is mandatory. Water is mandatory. Insurance becomes mandatory when risk rises. Optional goods collapse first. Luxury disappears. Speculation evaporates. These don't. Inflation resistance. When currencies weaken, real assets don't politely follow. They reprice violently upward. Food prices rise. Water access gets monetized. Insurance premiums explode. These assets don't just keep up with inflation, they feed on it. And then there's the final trait, the one no one likes to discuss. They benefit from instability. Not morally, mechanically. Drought makes water rights more valuable. Supply disruption makes farmland strategic. Volatility increases cat bond yields. That doesn't make the investors villains, it makes them realists. Here's the conspiracy adjacent layer most people miss. This isn't about predicting collapse, it's about accepting that instability is no longer temporary. The post-war era trained everyone to expect normalization, recessions followed by recoveries, crises followed by stability. But what if the cycle changed? What if volatility is now the baseline? If that's true, then traditional assets aren't just risky, they're structurally misaligned. And the ultra-wealthy adjusted accordingly, not emotionally, not politically, but architecturally. They repositioned into assets that sit outside the financial system. And once capital leaves a system, it rarely returns. Which brings us to the uncomfortable part for everyone watching. You can't copy this strategy directly, but you can understand it. And understanding it changes how you see everything else. Because once you see where the exits are, you can't unsee them. This is where most people ask the wrong question. They ask, how do I buy what billionaires buy? That's a trap, because you don't have their access, tax structures, or legal firewalls. Trying to imitate them directly is how retail investors get crushed. The real question is different. How do you get exposure to the same forces? Because exposure is about alignment, not ownership. Let's start with farmland. You're not buying thousands of acres, but you can ride the same pressure. Public farmland trusts exist for one reason: to let capital pool into agricultural land without direct ownership. They don't give you control, they don't give you water rights, but they track rising land values and food pricing, which matters when inflation isn't transitory. Then there's fractional ownership, platforms that pool capital to buy single farms. You're not trading pixels. You're tied to physical yield, crops, rent, land appreciation. It's slower, less exciting, which is exactly why it works. Now, water. This one is harder, by design. Water rights don't trade on exchanges. They move through contracts, lawyers, and patience. But scarcity leaks into public markets indirectly. Utilities that control distribution benefit. Infrastructure companies that manage filtration and pumping benefit. When water stress rises, regulation tightens, and incumbents gain pricing power. You're not owning the river, but you're standing downstream of the same trend. And then there's catastrophe risk. This is where things get counterintuitive. You don't need to understand meteorology. You need diversification. Funds exist that spread risk across dozens of catastrophe bonds, different regions, different triggers. One disaster doesn't wipe you out. The upside? Returns that don't flinch during market panic. The downside? Complexity, fees, and risk most people don't emotionally tolerate, which is why this space remains underowned. Here's the pattern again. Assets that require patience, discomfort, and long-term thinking stay cheap longer. Assets that promise speed and excitement get crowded fast. That's not an accident. And here's the final warning. Exposure doesn't mean safety. These assets have risk, real risk. But it's a different category of risk, one that doesn't rely on human confidence staying intact, which is the entire point. Because when confidence breaks, you want assets that don't notice. And that brings us to the real reason this strategy matters, not financially, psychologically. Here's the psychological shift most people never make. They think wealth is about growth, bigger numbers, faster gains, constant motion. That mindset only works in stable systems. But when systems enter long-term stress, the game changes, quietly, subtly. Wealth stops chasing upside and starts fleeing fragility. This is why these assets feel so unintuitive. They don't feel like winning. No charts exploding upward, no viral success stories, no bragging rights, just slow accumulation and silent positioning. That's not accidental, it's camouflage. Because the moment an asset becomes exciting, it becomes crowded, and crowded assets fail first under pressure. Here's the conspiracy-adjacent layer most people sense but can't articulate. The ultra-wealthy aren't predicting one collapse. They're planning for a permanent state of instability. Not apocalypse, not utopia. Volatility as normal. Shortages here, disruptions there, crises rotating, never resolving. In that world, speed becomes dangerous, liquidity becomes fragile, and leverage becomes lethal. So capital migrates to things that don't care. Land doesn't panic, water doesn't default, probability doesn't trend on social media. These assets don't win headlines, they win timelines. And notice something important. None of this requires conspiracy theories to be true. It works even if institutions are well-intentioned, because complexity alone creates fragility. Highly optimized systems break spectacularly when conditions change. Resilient systems look inefficient until they're the only ones still standing. That's why these investments look boring. They're intentionally inefficient. Redundancy, physical constraints, legal protections layered over time. That's resilience engineering, not speculation. And this is where retail investors usually lose the plot. They try to time it. They wait for confirmation. They look for signals on price charts. But positioning like this happens before confirmation. Once confirmation arrives, the window closes. That's the part that's hard to accept. By the time everyone agrees something matters, it already costs too much. So the real takeaway isn't buy this, it's see differently. Stop asking what's going up and start asking what can't fail easily. Because the next decade won't reward the fastest thinkers, it will reward the most patient ones. And now there's one final twist left, because these three assets don't just protect wealth, they quietly reshape power itself. Power doesn't always look like control. Sometimes it looks like optional silence. The ability to wait, to refuse bad terms, to step aside while others are forced to act. That's what these assets really buy. When food is scarce, those who control production don't need to shout. Prices speak for them. When water is limited, those who hold rights don't need influence. Infrastructure bends around them. When disasters accelerate, those who absorb risk don't need predictions. They become the backstop everyone else depends on. That's power without headlines. And here's the part most people misunderstand. This isn't about evil masterminds. It's about incentives. Systems reward whoever reduces uncertainty, and in unstable eras, certainty is more valuable than growth. That's why governments quietly partner with farmland owners, why cities negotiate with water right holders, why insurers rely on catastrophe capital instead of balance sheets. Dependence flows upward. And once dependency forms, influence follows, even if no one ever admits it out loud. This is how power shifts without elections, coups, or revolutions. It migrates through infrastructure, food systems, water systems, risk systems. Whoever anchors those systems doesn't need to win arguments. They set boundaries. And boundaries shape outcomes more than opinions ever will. That's why this strategy matters beyond money. It explains why certain decisions feel inevitable, why some policies never change, why shortages are managed instead of solved, because solving them would dismantle the leverage they create. Now step back and notice something uncomfortable. None of this requires collapse. It works in slow decline. It works in constant crisis. It even works in partial recovery, as long as volatility never fully disappears. Which is exactly the world we're moving into. So here's the final truth. The future won't be owned by whoever predicts it best. It will be shaped by whoever positions themselves where the system can't function without them. That's what farmland, water rights, and catastrophe risk really are. Not investments. Anchors. And once anchors are set, the rest of the system drifts around them. That's the strategy no one explains plainly, because once you see it, you stop chasing noise and start paying attention to what everything quietly depends on.